The holy grail of investing is the ability to earn money while you sleep. Passive income from ETFs can be a good way to discover that holy grail. This video will give you the knowledge you need to create a passive income stream using ETFs. When people think of ETFs, shares are often what first come to mind, but for income-seeking investors, ETFs offer a wide range of options. Many of these ETFs now offer significantly higher yields than just a couple of years ago. Watch until the end of this video to learn about a popular way to build a portfolio for income. But first, here are 4 types of assets that investors can use to generate income from ETFs. Equity income. Australians have long been attracted to equities for their dividend yields and franking credits, but there's more to equity income than just buying blue chip stocks for the dividends. Equity income ETFs give you access to companies paying out large dividends. In addition to these passive equity strategies, some other strategies involve selling options to boost income. Others aim to harvest dividends and franking credits by regularly rebalancing into companies that are expected to pay a dividend in the months ahead. These more complex strategies can help you get more income out of your investment. Another huge benefit of equity income in the case of Australian equities is access to franking credits, which help investors maximize their after-tax return. Finally, because the underlying holdings of these ETFs are stocks, investors also have the opportunity to realize capital gain through the growth in share price of the underlying holdings. Our next asset class is fixed income. Fixed income plays a key role in investors' portfolios, providing not only income, but also defensive attributes. Investing in fixed income is essentially buying debt, which the borrower needs to pay back with interest. Depending on the creditworthiness of the borrower and the length of time until the money is paid back, the yield might be higher or lower. For investors seeking a defensive exposure for their nest egg, fixed income generally offers less volatility. In certain economic scenarios, some bonds, like government bonds, may also have a negative correlation to equities, which means that as share prices fall, the price of these bonds will rise. In general, fixed income offers regular income with distributions paid either monthly or quarterly. If you're after a more comprehensive explanation for fixed income or bonds, check out our guide up here. Our third asset class is hybrids. Hybrids have elements of both bonds and shares and sit somewhere in between the two for levels of risk and return. In Australia, banks are by far the most common issuer, and hybrid securities usually come in the form of preference shares. These shares offer investors a fixed dividend, making them attractive for investors who are looking for predictable income when compared to common stock. Additionally, preference shares tend to have less price volatility when compared to their common share counterparts. This can be a benefit when a company performs poorly, but also a limitation when the company performs well. The cost of higher dividend payments than common shares is reduced potential for capital growth. And our fourth and final asset class for passive income is cash. Cash is a great option for lots of investors as it offers capital protection. The good news for investors is that cash is currently offering the best rates in more than a decade, and cash ETFs often allow investors to receive institutional interest rates when compared to cash held in bank accounts. ETFs like the BetaShares Australia High Interest Cash ETF offer an attractive yield paid in monthly distributions. Cash has historically produced lower returns than other asset classes over the long term, but it can be a reliable option for managing those short-term needs. Those are some of the best asset classes for passive income. We've linked all of our income ETFs in the description of this video below, split into these 4 different categories. So now that we've covered a few of the different ways that you can achieve passive income, let's discuss how you might use them in an investment strategy. Investing for income requires a different mindset and approach than accumulating. For example, during the accumulation phase, taking on more risk may be an acceptable trade-off for greater long-term returns. But once you're selling investments to fund your lifestyle, price volatility can have a serious impact on how long your money lasts. Particularly in the early stages of retirement, large investment losses can change the trajectory of your life. This is known as sequencing risk. One popular investment strategy that aims to manage the risks that investors face during this drawdown is called a bucket strategy. This strategy involves splitting your funds into 3 different buckets: cash, fixed income, and growth. Cash consists of a year or more worth of living expenses and possibly an emergency fund for unexpected costs. As the cash bucket depletes, attention shifts to fixed income. This bucket aims for capital preservation, but is less conservative than the cash bucket. It's generally anchored by high-quality government and corporate bonds, but may also include a small allocation to hybrids or low-grade bonds. The final bucket is growth. Investment doesn't end at retirement. For people aged 60 today, life expectancy is another 24 to 27 years, allowing for a further 2 decades of investment. As such, growth investment may still form an important part of a retirement investment strategy. Growth investments typically include shares and may include property or other growth assets. The goal is to fund living expenses from the cash bucket, along with any distributions or dividends from the other buckets. If the cash bucket gets low, it can be topped up by selling down assets in either the second or third bucket, depending on which has performed the best recently. This acts as a form of rebalancing, allowing investors to get back to their target allocation across the buckets. By using the bucket strategy, investors can get the most out of their investments for regular passive income, while still maintaining a solid nest egg for investing. We see building a sustainable income stream in 2024 as a key objective for Australian investors. For more information on the different ETFs that can help you achieve that, check out some of the links that we've put down in the description. And for more content that can help you start out on your investment journey, subscribe to the channel to stay updated. See you next time.